talking about this, or at least writing about it back and forth, you and I got to mention, we had Frank Slootman, the CEO of Snowflake, on yesterday. Big startup, $4 billion valuation. He's taken 2 enterprise companies public in the past. He told me yesterday he's considering a direct listing for Snowflake. Is this a sea change?
Well, I hope it's a sea change. You know, I would disagree with one thing Carl said, that, you know, he tried to tie this effort to, 2 or 3 IPOs that have broken issue. This is a problem that Silicon Valley's been tilting at for over 20 years. I went back, since I was on last, I went back and studied some of the history. Pierre Omidyar in 98 said this IPO process is very undemocratic. Bill Hambrick, 99, 20 years ago, said, look, and after 30 years in the security business, he said, IPOs are an insider's game. We got to try and fix them. And then, of course, Larry and Sergey with the Dutch auction, and you read of why they did it. You come back to these 2 core themes. They're talking about, is the price and allocation market-based? And do we have open and equal access for all? Those are 2 core tenets that seem to be something everyone could get behind. In the traditional IPO process, neither of those things are true. You don't have a market-based price discovery, and you don't have open and equal access to all. It turns out that Barry McCarthy spent 2 years tilting against this opportunity called a direct listing, and he kicked that door open. And the more I was able to study that and understand how it works, it solves those core 2 issues. You have market-based pricing and market-based allocation, and you have open and equal access for all. If you put in a bid at 3801 from a Robinhood account and they open at 38, you're filled. That is absolutely not true in the IPO process. And so this is totally unrelated to anything that happened this year. There's 20 years of data. We had Jay Ritter at our event and go through all the data. 30, 40 years, over the past 38 years, 171 billion in first day wealth transfer. And in the past 3 years, that's 15 billion. And even this year, with the 3 companies that you mentioned that broke issue, it's still a net 6 billion positive in first day trades.
So Bill, tell us how you read the tone of the meeting, and were there questions about what about the startups that aren't mega unicorns able to raise a bunch of money right before doing a direct listing, the startups that actually need cash? Will this work for them? Did you get questions like that in the meeting? What was the back and forth like?
Well, look, I would say the general tone was quite positive. One of the reasons that this happens over and over again is you have a remarkable frequency and balance between entrepreneurs and CEOs. Most people aren't like Frank Slootman that have done it 2 or 3 times. Most of these people do it once in their life. And so we were able to organize the top 125 private companies that would be next in line and share a whole bunch of information with them, from lawyers. We had everyone from Spotify, everyone from Slack that had done this before, and show them how they can, take this approach that is very appealing. We're all tech oriented out here. The notion of things being open and transparent and accessible is consistent with how we view the internet and what it enables. And so I think people were super open-minded. To the point of capital, of course, the current direct listing does not allow you to raise capital. One thing is true, though. There's still tons of late-stage capital. One of the reasons that people have delayed IPOs is because there's so much capital out there. And so we talked with the whole group about ways we could organize that would allow you to do a quick fundraise prior to a direct listing. There's a whole bunch of progress around that. And then the thing we heard from people like Stacy Cunningham, who runs the NYC, where you guys are right now, there are efforts underway to add primary capital to the direct listing. And so I think that problem's going to solve itself. What we are looking for in that group is to find more pioneers like Barry McCarthy and Daniel Ek at Spotify and Stuart Butterfield at Slack that want to get behind this approach that is frankly a lot more intellectually appealing to everyone in my community.
Got it. What do you know about the effort specifically to add the fundraise to the direct listings process? How far out is that? Who's working on it? Are you talking to those people?
I haven't been directly involved in that. I've spent the past 6 weeks working on this event so that we could all come together and share information. And by the way, I think the thing we're going to continue to do is stay organized in this way so that we can all share information. Several of the investment banks that are out there are leaning into this. They're helping with the initiative to try and add primary. They're telling their accounts that they also believe in direct listings, and we want to get behind the people that are behind that movement.
Bill Morgan here. Given the fact that Benchmark is an investor in WeWork, I wonder if you think things would have gone a little bit differently if WeWork had taken the direct listing approach. Do you think it could have even done that?
I don't. Once again, this is a movement that we're trying to solve a problem that we first recognized 20 years ago. And, I almost think about this as something that I hope will be part of my legacy, as something I can give back to Silicon Valley by trying to move us away from this thing that's clearly been not in our company's best interest. And so I think it's unrelated to any one company, really. It's about finding a better way. Once again, two tenets, market-based pricing, one of the core financial tenets of all markets, around the world, and equal and open access. I don't know how anyone could tilt against those two things.
Have you had conversations with any of the folks on Wall Street, whether it is the banks or institutional investors or even the exchanges? What's the reaction been like?
Oh, absolutely. As I mentioned, Stacey Cunningham, the president of the NYC, was at our event yesterday. So yeah, I've been, it's one of the few things I've ever been involved in that's kind of brought the whole venture community together. We had over 25 firms sponsoring this event yesterday. We're talking with anybody and everybody about this. And, yesterday there was news out that Airbnb is going to go this way, get Snowflake, Airbnb. This would be wonderful momentum behind, Spotify and Slack.
Well, Bill, speaking of momentum, we get your point about it being a 20-year effort, and it is. But it's these recent blow-ups that have given you the tailwind to make it possible, right?
Once again, I would actually back away from saying that this is related to anything in the near term. This is, the data about how Silicon Valley companies have been taken advantage of by this broken process it goes back 30 years or 30 or 40 years. And so it's unfortunate. In the past 3 years, it's gotten worse. And I think that's because the IPO process has devolved. It's a whole nother subject matter. But I think it used to be that the IPO process was about disseminating and marketing and selling far and wide. And it's become a game of just hand allocating shares to the same 10 or 15 firms. And so as that has happened, it's gotten worse, and the underpricing's gone up and up and up. And if anything's been a trigger, I guess, for us getting more active, it's just that those underpricing percentages have gotten worse and worse and worse. But once again, it's unrelated to any activity of the past 3 or 4 weeks in the financial market.
Are you sensing any behavioral adjustments by the underwriters themselves?
A few of them are leaning in and saying we completely understand why you would think this way. And quite frankly, I think it's hard, once again, market-based pricing, open and equal access. It's really hard to tilt against those things. A number of our speakers yesterday got inbound text messages from banks over the past 3 or 4 days, and they would show them to me and they would say, "Be nice." And I was like, "Be nice?" That sounds like a weird mea culpa. Why aren't you saying, no, you should do it our way? But there's no counter argument. There's really no counter argument.
Bill, I want to go more into that because 15 years ago when Google had its IPO, did the Dutch auction, the kind of postmortem on it was that Wall Street kneecapped it, right? That actively tried to make it not work the way that Google planned. Yeah. Is this still going to be a fight? Do you still expect that kind of opposition to this move toward direct listings?
Anytime you're trying to change a system that's been in place that long, I totally expect a fight, and I think it'll be extremely hard. So I'm not here to declare victory in any way whatsoever. There's one element of the direct listing that's very, very different from the Dutch auction. So the Dutch auction was propped up as a new technology stack, a new process. It actually lived, software that was written by Hambick and Quest, and then a whole nother stack written by Morgan Stanley. What Barry McCarthy unlocked and discovered was that the very same processes that you use at the NYSE and the NASDAQ to open stocks each and every day can actually do the match that do a direct listing opening. And so in the direct listing process, you're actually removing steps, because once you do an IPO, you actually do with the exact equivalent of direct listing opening the next morning. And so you remove that step of the hand allocation, hand pricing, and you jump straight to this market open. But what's really remarkable and very different from the Dutch auction, these systems are already inside of our financial markets. And so the direct market makers that are around you guys on the floor right now, when they opened any and every stock today, they're using that exact same process for a direct listing. And so I think we have a much more elegant approach than the one that was the Dutch auction, with the exact same outcome that solves the exact same problem. So I think it's a lot more durable.